which are not doing well are the FMCG stocks. In fact, as we speak, Marico is at the low point of trade, despite reporting an inline set of numbers in the first quarter. That perhaps could be on account of profit taking, because going into numbers, the stock was about 6% higher in the previous two trading sessions itself. The company's reported a 3% volume growth and also recently announced their foray into buying the D2C brand Plix. Saugata Gupta, who's the MD and CEO at Marico, now joins us. Saugata, always a pleasure speaking with you. Before we talk about your numbers, which were largely in line with expectations, what are your thoughts on the Plix acquisition first? I mean, what's the revenue scalability here? What's their profitability, and how much higher can you take it?
So I think, as you know, most of the digital brands, we follow a same path where we take a certain stake, and then over the corresponding 3 years, we start getting into 100%. That's what has happened in Beardo. That will happen in other brands. As far as Plix is concerned, I think two things are very interesting. One is the space of nutraceuticals and functional foods, and they have made it fun instead of being serious space, because that leads to a kind of that is a kind of a penetration expansion blocker, because ultimately you need to promote functional foods or nutraceuticals on the concept of a healthy way of living as opposed to a supper. And they have clocked well, I think. And as I said, we've looked at some of the capabilities that are required to do digital business, including addressable market, the way they do digital marketing, and the founders. I think all of them sound exciting. And I believe that they will on the growth path. At the same time, what is also encouraging is they are doing it at a very low cash burn.
Okay, Mr. Gupta, good morning and thanks for joining in. What is the gross margin and the cash burn that we've seen of Plix currently?
So compared to other foods, obviously nutraceuticals and wellness products makes higher gross margin, and the cash burn is relatively low compared to similar brands available in the system.
Okay. What is the volume improvement that you're probably looking at? Would you be able to help us with maybe a range?
No, it's difficult to give a range at this time. All we can say is that definitely we believe that I think at the 3% which we did, we could have perhaps a little more, but for the one-offs. And we expect this one to gradually improve as we move to Q2 to Q4.
All right, you're not giving us a lot of numbers here, Saugata. I just wanted to know on the revenues itself. The second half, you said that your revenues will turn into positive territory. What exactly are you targeting for the entire year?
See, again, it depends on as you know, the external conditions, while it's much less volatile than it was last year, it's unpredictable. Whether it's the copra or the edible oil, both of these determine the extent of deflation and inflation, to an extent crude, but I would tend to believe that crude will be far more stabler. What we know this year, and it's based on the anniversarization of the deflation inflation scenario, because as you know, in Q1 Saffola prices were 30% lower than what it was last year, which was the peak of inflation immediately post the Ukraine war started. So I would tend to say that you can see the deflation factor gradually reducing, and therefore in the second half, whatever is the volume growth ending up in revenue growth, it could be a slight inflation, which at this stage, as I said, there's no point trying to give a number, hazard a guess, because in today's times, while it's less volatile, it continues to be volatile.
So let's talk about ad spends then. How much higher can ad spends get to as a percentage of sales? I mean, competitive intensity is increasing as we speak. So will ad spends also move up?
So there are two things. And when you deal with much more smaller players, pricing and distribution execution plays an equally important role. Having said that, yes, if you look at even last year, we hadn't actually, as an organization, we believe, because we had been doing the diversification journey, that we need to invest in A&P. Even last year, when it was the maximum inflation impact, we never shied away from investing in A&P and therefore we had spends growth. This year also we started out with growing spend. But yes, the A&P percentage might move up a little bit, and we will continue to invest to get back growth. This is a great opportunity, I think, to get back growth and protect market share. As you know that in the last quarter also, in 85% of the portfolio, we gained a protected market share and penetration. So therefore, that journey will continue, and therefore, going forward, some of the gains of gross margin will be plowed towards ad spend. See, this quarter also we didn't get operating leverage because of the deflation. So that operating leverage will also start coming in, which means that in spite of, we continue to hold the fact that we will continue to deliver 20% plus operating margin for the full year, which gives us the kind of a space to actually invest behind higher A&P in the balance 3 quarters.
Okay. What kind of outlook can you then provide us for all of your segments?
So I think the growths of value-added hair oils and Parachute will be definitely better in the balance year than what it has been this quarter. We are fairly steady as far as the diversification journey is concerned. We hope to exit this year at 20% of our new categories in India, which is basically the digital brands, premium personal care, which is serums, oil, with serums, male grooming and food. That should contribute to around 20% this year as we exit this year. So I think that's the broad feeling, and this diversification will continue. Having said that, I think we're equally cognizant of the fact that we need to deliver, improve our margins on food, at the same time reduce the kind of a burn rate on digital, because if they constitute a significant portion of our top line, they need to get into the overall EBITDA margins of the overall business.
All right, so you're looking to reduce your burn in the digital brands and improve your margins in the food business as well. Speaking of the food business itself, you've targeted 850 crores in terms of food business revenue for this year. Is there any reason why it's at the lower end of the 850 to 1,000 crore range that you had spoken about? And on margins, I mean, what is the current profitability of the food business?
So I think, that 1,000 crores is an aspiration. I think the very fact that we started with sub 200 crores in 20, we have made a significant leap. And at the same time, you must also realize that food requires a different supply chain. We have to ensure that we grow while keeping in mind that profitability. And I think in masala oats and oats, where we have got scale, we do make a good gross margin and a good EBITDA. And therefore, we know that we need to get into scale in foods. Once we get scale in foods, we should be able to deliver a certain margin which is not dilutive. And I think it's better to do it in a systemic way than just doing scale for the scale of it. The other thing is, we are clear we're not going to get into commodities. So therefore, whatever we do as we expand Saffola, it has to be margin accretive and not margin dilutive.
Okay, all the best in your journey. Thanks a lot for joining us and speaking to CNBC TV18. That's Marico. Let's slip into a quick break. On the other side, we'll put focus on TCS's new operating